Money was never meant to shape the world. Its original purpose was simple: to make trade easier, to replace barter, to create a common measure of value. For centuries, every nation issued its own currency. Each served its own economy. Each stopped at its own borders. But the modern economy changed the rules. International trade expanded. Capital moved across continents. Businesses operated in dozens of countries at once. The world needed more than national currencies. It needed a common financial language. Over time, one currency gradually filled that role. Not because every country was required to use it, but because using the same system made global commerce faster, simpler, and more predictable. Today, a company in Asia can purchase equipment from Europe. An energy producer in the Middle East can sell oil to South America. An investor in Africa can buy shares listed in New York. These transactions involve different governments, different laws, and different markets. Yet many are connected by the same financial foundation: the US dollar. This is no longer just a currency. It is infrastructure. And like every successful infrastructure, its greatest achievement is becoming almost invisible. Most people never ask why international business relies on the dollar. They simply assume that is how the world works. But every global system has an architecture, and every architecture has a beginning. The story of the dollar is not simply the story of money. It is the story of how one financial system quietly became part of the operating system of modern civilization. As global trade expanded, money faced a new challenge. Every country had its own currency. Every currency carried its own exchange rate. Every international transaction introduced uncertainty. A manufacturer exporting products overseas had to manage foreign exchange risk. An investor buying assets abroad had to monitor multiple currencies. Banks needed to convert money before payments could be completed. The larger the global economy became, the more complicated the financial system became. Commerce needed something more efficient, not a world with one government, but a world with one trusted financial reference. The US dollar gradually became that reference. Businesses discovered that pricing goods in dollars reduced uncertainty. Banks found it easier to settle international transactions using a widely accepted currency. Central banks began holding dollars as reserve assets to support their own financial stability. As more participants joined the system, the benefits multiplied. Importers preferred suppliers using dollars. Exporters preferred customers already paying in dollars. Investors preferred markets where liquidity was deepest. Each decision was rational on its own. Together, they created one of the most powerful network effects in financial history. The dollar was no longer serving only the American economy. It was becoming the common language of global commerce. This is how financial architecture evolves, not through a single decision, but through millions of independent decisions moving in the same direction. Eventually, the system becomes so widely adopted that most people stop questioning why it exists. They simply build their businesses around it. Because once a financial system becomes the easiest way to connect the global economy, it begins shaping the architecture of global trade itself. Trade was only the beginning. As international commerce expanded, countries faced another challenge. How do you protect your economy during uncertainty? Every central bank needs reserves, assets that can be used to stabilize its currency, support imports, repay international obligations, and maintain confidence during financial crises. The question is not whether reserves are necessary. The question is which assets the world trusts most. Over time, many central banks reached the same conclusion. They accumulated US dollars. Not because they were required to, but because the dollar offered something every financial system values: liquidity, stability, and global acceptance. This transformed the dollar into far more than a trading currency. It became the world's primary reserve currency. That distinction carries enormous significance. When countries hold the same reserve asset, they create a shared financial foundation. International lending becomes easier. Global trade becomes more predictable. Cross-border investment becomes more efficient. Confidence spreads throughout the system. The more confidence grows, the more institutions choose to hold the same reserve, and every new participant further strengthens the architecture. This is one of the defining characteristics of systemic power. Trust is rarely imposed. It is accumulated, one decision at a time, one institution at a time, one country at a time. Eventually, confidence becomes self-reinforcing. The system no longer survives because someone protects it. It survives because everyone believes everyone else will continue using it. That is the hidden architecture behind reserve currencies. Their greatest strength is not the paper they are printed on. It is the confidence that billions of people quietly place in the system behind them.
Every economy depends on energy. Factories require it. Airlines consume it. Ships transport it. Cities cannot function without it. For decades, one commodity has stood at the center of the global energy system: oil. But there is another question most people never ask. Why is oil commonly traded in US dollars? The answer extends far beyond energy. When buyers and sellers across different continents use the same currency, international trade becomes significantly more efficient. Price comparisons become simpler. Financial contracts become more predictable. Global markets become more liquid. As oil producers, importers, banks, and commodity traders increasingly settled transactions in dollars, a powerful cycle began to emerge. Countries purchasing energy needed dollar reserves. Banks financing energy projects held more dollars. Commodity exchanges expanded dollar-based contracts. Investors followed the same market. One industry strengthened another. Trade reinforced finance. Finance reinforced demand. Demand reinforced the architecture. This did not happen overnight. It evolved over decades as the global energy market became increasingly interconnected. Eventually, the dollar became deeply embedded in one of the world's most essential industries. That relationship extended its influence far beyond banking. It connected energy security with financial infrastructure. This illustrates an important principle of systemic architecture. The strongest systems rarely operate alone. They reinforce one another. Energy supports industry. Industry supports trade. Trade supports finance. Finance strengthens the currency supporting the entire network. That is why the dollar became more than a medium of exchange. It became one of the structural layers supporting the global economy. Because when the world's most important industries operate through the same financial system, that system gradually becomes part of the architecture of modern civilization.
Why doesn't the world simply replace the dollar with another currency? At first glance, the answer seems straightforward. Use a different system. Adopt another currency. Continue trading. In reality, financial architecture is far more complex. The value of a global currency does not come only from economic strength. It comes from participation. Every company accepting dollars makes the system more useful. Every bank settling transactions in dollars increases its efficiency. Every investor holding dollar-denominated assets improves market liquidity. Every central bank adding dollars to its reserves reinforces global confidence. This is the power of network effects. The larger the network becomes, the greater the benefit of joining it. Eventually, the architecture reaches a tipping point. The system is no longer dominant because it is the largest. It remains dominant because everyone else is already connected to it. Replacing a currency at global scale is not like changing a payment app. It requires banks to update infrastructure, businesses to rewrite contracts, governments to adjust reserve strategies, investors to move trillions of dollars into new markets. The challenge is not creating an alternative. The challenge is recreating an entire ecosystem. That is why financial systems rarely change quickly. They evolve over decades. Each new participant makes the architecture stronger. Each new connection increases stability. Each successful transaction builds additional confidence. The world often believes money creates power. In reality, systems create power. Money simply flows through them. And once billions of transactions begin flowing through the same architecture, the system becomes far more valuable than the currency itself.
Trade creates wealth. Capital determines where that wealth grows. Every year, investors allocate trillions of dollars across the global economy. They finance governments, support businesses, fund infrastructure, and invest in technologies that may define the future. But capital has one defining characteristic: it seeks confidence. Investors are not simply looking for the highest return. They are looking for predictable systems, clear regulations, deep financial markets, reliable institutions, and assets that can be bought or sold without disrupting the market. This is where the dollar architecture becomes especially powerful. Many of the world's largest financial markets operate in dollars. Government bonds, corporate debt, equity markets, international lending, foreign exchange. These markets create extraordinary liquidity. Liquidity attracts investors. Investors deepen the markets. Deeper markets increase confidence, and greater confidence attracts even more capital. The cycle reinforces itself. Over time, the dollar became more than the currency used in global trade. It became the currency through which much of the world's investment capital flows. This gives the financial system remarkable flexibility. A company developing artificial intelligence, a government building new infrastructure, or a startup launching breakthrough technology can all access the same global capital architecture. That is the hidden relationship between money and innovation. Ideas require funding. Funding requires confidence. Confidence requires systems. The world often celebrates the companies that change industries. But behind every successful company stands an invisible financial architecture that made long-term investment possible. Because before innovation transforms civilization, capital must first decide where the future will be built. Financial systems reveal their true strength during periods of uncertainty. When markets are stable, almost every investment appears attractive. Capital spreads across industries. Risk is easier to accept. Growth becomes the primary objective. But uncertainty changes behavior. Investors begin asking different questions. Where is liquidity? Which assets can be trusted? Which markets can absorb enormous volumes without breaking? During these moments, confidence becomes more valuable than return. Historically, global capital has often moved toward dollar-denominated assets during periods of financial stress, not because every other market disappears, but because investors value stability when uncertainty increases. Governments, financial institutions, and multinational corporations make similar calculations. Preserving confidence becomes the first priority. This reveals another characteristic of systemic architecture. The strongest systems are not measured only by how they perform during prosperity. They are measured by how they respond under pressure. Infrastructure that continues operating during disruption becomes even more valuable afterward. Confidence deepens, participation grows, the architecture becomes stronger than before. This is why financial influence cannot be understood by looking only at economic growth. Resilience is equally important. A system that remains trusted during uncertainty gradually becomes embedded within the long-term decisions of governments, businesses, and investors. Over decades, that trust becomes part of the architecture itself. Because in global finance, confidence is not simply an emotion, it is infrastructure. And the systems that preserve confidence during moments of uncertainty often become the systems the world depends upon the most. Every dominant system eventually faces the same question: can it be replaced? The discussion often focuses on currencies, the euro, the Chinese yuan,
digital currencies, central bank digital currencies, or entirely new financial technologies. These developments are significant. They continue reshaping the global financial landscape. But replacing a global financial architecture involves far more than introducing another currency. A reserve currency exists within an entire ecosystem. Banks, capital markets, payment infrastructure, legal institutions, international contracts, liquidity, trust, global participation. Each layer supports every other layer. Changing one component without rebuilding the rest rarely transforms the entire system. This is why financial architecture evolves gradually. History shows that dominant systems are not replaced simply because alternatives appear. They change when a more complete architecture emerges, one that is equally trusted, equally liquid, equally efficient, and equally connected. That process can take decades, sometimes generations. The question is not whether the global financial system will continue evolving. It almost certainly will. The more important question is this: which architecture will future generations choose to build upon? Because every new generation inherits systems it did not create, then slowly decides whether to improve them or replace them. The future of global finance will not be determined by a single announcement. It will be determined by millions of independent decisions made by governments, businesses, investors, and institutions around the world. That is how every great system has always evolved, one connection at a time.
By now, one pattern becomes clear. The dollar did not become globally influential because it was simply another currency. It became influential because it was embedded inside a much larger system: international trade, global banking, capital markets, energy markets, payment infrastructure, financial regulation, investment networks. Each layer reinforced the next. The currency strengthened the markets strengthened confidence. Confidence attracted participation. Participation strengthened the architecture. This is how modern systems grow, not through one extraordinary event, but through thousands of interconnected decisions made over decades. Eventually, the architecture becomes larger than any individual institution. Businesses begin designing around it. Governments build policies around it. Investors measure opportunities through it. Universities teach future professionals within it. The system quietly becomes part of everyday life. Most people never notice this transformation. They see money moving. They rarely see the architecture moving money. That distinction changes everything. Currencies can rise, currencies can fall, exchange rates change every day, but architecture operates on a much longer timeline. It shapes how capital flows, how markets develop, how industries expand, and how civilizations coordinate economic activity across continents. This is why understanding the dollar requires looking beyond finance. The real story has never been about money alone. It has always been about the systems that allow money to move. Because history is rarely transformed by a currency. It is transformed by the architecture that gives that currency global meaning.
Looking at the dollar alone tells only part of the story. Currencies do not create global systems. They operate within them. Behind every international payment stands a banking network. Behind every investment stands a capital market. Behind every trade agreement stands decades of institutional development. Behind every financial decision stands confidence built over generations. The dollar became globally significant because it was supported by an architecture capable of connecting all of these layers together. That is the defining lesson of modern finance. The world's most influential systems are rarely built overnight. They evolve, they expand, they gain trust, and eventually, they become part of everyday life. Today, billions of people participate in the global economy without thinking about the financial architecture beneath it. A business imports products. A traveler exchanges currency. An investor buys international assets. A government issues sovereign debt. Each action appears ordinary. Together, they sustain one of the largest financial systems humanity has ever created. This is why the story of the dollar is not simply about one nation or one currency. It is the story of how modern civilization organized global commerce around a shared financial architecture. Whether that architecture continues to evolve or one day gives way to another, history suggests the same principle will remain true. The future will belong not to those who create the next currency, but to those who build the next system the world chooses to trust.
Money is one of humanity's oldest inventions. Financial architecture is one of its greatest achievements. The world does not move because a single currency exists. It moves because billions of people trust the systems connecting economies across continents. Currencies may change. Markets will continue evolving. New technologies will emerge. But one principle remains constant. Civilizations advance when trust can move faster than distance. Because beneath every global economy, there is a financial architecture. Beneath every financial architecture, there is a system, and those who understand the system begin to understand how the modern world truly works. This is LEXERA, decoding the architecture of modern civilization.